Have you ever pondered the intricate dance of capital that fuels the world of private investment funds, such as the powerful engines of private equity or the dynamic forces of venture capital? It is a fascinating process, for more nuanced than a simple transfer of funds. Unlike publicly traded securities where you buy shares directly, private funds operate on a carefully choreographed system to gather and deploy immense wealth. Imagine a complex financial symphony where every note, every dollar, is played with precision and purpose. This deliberate approach ensures that capital is not just available, but is also utilized with maximum efficiency when opportunity strikes. At its core, committed capital flows to a private fund primarily through a mechanism universally known as capital calls or drawdowns. Here is the direct answer. Investors, typically referred to as limited partners, sign a legally binding pledge or commitment to invest a specified amount of capital over the entire lifespan of the fund. The general partner, who is the fund manager, then systematically requests or calls upon this committed capital in a series of stages, only as legitimate investment opportunities mature and become actionable. This staged capital flow is not merely a convenience. It is a fundamental pillar of private fund operations, meticulously outlined and legally enforced within the fund's foundational governing documents. The most critical among these are the Limited Partnership Agreement, often called the LPA, and the Subscription Agreement. The LPA lays out the comprehensive terms and conditions of the partnership, including how and when capital will be requested. The Subscription Agreement, on the other hand, is the specific document where each individual limited partner formally and legally commits their precise capital amount to the fund. Following these commitments, the fund manager diligently tracks and manages what are termed unfunded commitments. These unfunded commitments representing the portion of the limited partner's total pledged capital that has not yet been requested or drawn down by the fund. This structured approach is strategically designed to prevent vast sums of capital from sitting idly in a fund's bank account for extended periods. Idle capital generates minimal or no returns, which can significantly dilute the fund's overall performance. Instead, capital is deployed on a just-in-time basis, ensuring that funds are called precisely when they are needed for specific, identified investment purposes. This alignment between capital availability and investment deployment is paramount because private investments are inherently illiquid and frequently requiring substantial capital outlays only at particular, often unpredictable, milestones. These milestones might include the finalization of an acquisition, a strategic follow-on funding round for a burgeoning portfolio company, or the construction phase of a new infrastructure project. The staggered capital call process optimizes liquidity management for both the fund and its limited partners, allowing investors to manage their own cash flow more effectively rather than tying up all committed capital upfront. The practical implementation of this capital flow involves a series of clear, actionable steps. When a fund manager, the general partner, successfully identifies a compelling new investment opportunity, or determines that additional capital is required for an existing portfolio company to achieve its next stage of growth, they initiate a formal capital call. This involves issuing a detailed capital call notice to all limited partners. This notice is not a casual request. It is a legal document that precisely specifies several key pieces of information. It outlines the exact amount of capital being requested from each limited partner, clearly states the specific reason for the call, for example, to fund the acquisition of Company X, and, critically, it provides a precise deadline for when the funds must be transferred, typically ranging from 10 to 20 business days from the notice date. Upon receiving this notice, each limited partner is legally obligated to contribute their pro rata share of the requested amount. This means their contribution is proportional to their initial total commitment to the fund. For example, if an investor initially committed 5% of the total fund capital, they would be required to fund 5% of every subsequent capital call. This systematic process demands that limited partners maintain robust internal liquidity management practices to ensure they can meet these capital calls promptly and without fail. A failure to fund a capital call can have serious repercussions for the limited partner, including significant penalties, potential forfeiture of their investment, or even the loss of their partnership interest, all as stipulated in the limited partnership agreement. To truly grasp the sophistication of private fund capital flow, it is helpful to delve into a couple of insider details that go beyond common knowledge. One crucial concept is the investment period, which typically spans the first 3 to 5 years of a fund's life. During this defined period, the fund is actively engaged in seeking, evaluating, and making new primary investments into companies or assets. After the expiration of this investment period, the ability to make new capital calls for primary investments is generally curtailed. Instead, any subsequent capital calls are usually restricted to what are termed follow-on investments in existing portfolio companies, or to cover the ongoing operational expenses of the fund itself. Another fascinating aspect is the inclusion of recycling provisions in some limited partnership agreements. These provisions allow capital that is returned to the fund from early investment exits or from interim repayments and distributions within the investment period to be reinvested into new opportunities. This mechanism effectively recycles capital, allowing the fund to maximize the deployment of its committed capital and potentially enhancing overall returns without calling for additional fresh capital from limited partners. These provisions underscore the dynamic and adaptive nature of private fund management. In essence, the meticulously structured flow of committed capital, facilitated by carefully timed capital calls, represents a highly efficient and disciplined framework for private market investing. This robust system adeptly aligns investor contributions with genuine high-potential investment opportunities, thereby minimizing the drag caused by uninvested cash. Furthermore, it skillfully manages the inherent long-term, illiquid nature of private market investments. By ensuring that capital is available precisely when it is needed for strategic deployment, this mechanism not only optimizes financial efficiency, but also establishes a secure and predictable foundation for driving significant value creation for all stakeholders involved. It is a testament to the sophisticated engineering behind private capital markets.